Welcome back. I don't waste your time. Let's get straight into it. One of the first 10, probably maybe even 15 things that you hear about when you start investing is just put your money in the S&P 500. Go ahead, just buy the S&P 500. You get a tiny piece of every company, every major company in the US, and it's the most reliable, easiest way to start investing and make money over a really long period of time. And there's very minimal downsides if you have a long-term view. Today, we're going to be looking at the company behind the S&P 500 index, S&P Global, which also stands for Standard & Poor's. But as we dive in here, we'll see that there is a long history of acquisition and getting bought up by McGraw-Hill, which might also ring a name because they do a lot of textbooks and that type of stuff. But to start off, I want to read a introduction into the history of the company. And I'm sure as some of you guys have researched the company, even for those who are well-versed in S&P Global, we'll find something insightful. This is by the author Ben Toohey. I'll leave the link to this article in the description, but he says S&P Global, SPGI, Standard & Poor's, whatever, heritage dates back to the early days of the burgeoning railroad industry in 1860, when the company initially provided historic information on the industry to help investors make more informed decisions. So this is how they started. They would give information on the railroads and possible acquisitions and all that type of stuff. However, it was until 1916 did the company report its first credit rating, what is now famous for today. So if you didn't know, not only does S&P Global do the indexes, but they also are the biggest, or tied with Moody's, I guess, as the two biggest credit rating agencies. So if there's a company that wants to take out debt and would like to go to the market to get a lender to pay them, they need to be creditworthy. So this is where you would see the double A's, the triple A's, double B minus, whatever, and you see re-ratings of them going up and down and whatever. And they actually rate countries as well, right? So how creditworthy Argentina is, creditworthy the US is. So recently you heard that Fitch, which is another credit rating agency, they actually downgraded the US economy to I believe it was a double A plus. Yeah. So anyways, moving on. In 1966, Standard & Poor's was acquired by McGraw-Hill, where it resided for 47 years until the sale of the education segment in 2013, resulting in the RemainCo McGraw-Hill Financial, later renamed S&P Global. Since its humble beginnings, Standard & Poor's has developed into a leading provider of credit rating assessments. Remember this, we're gonna come back to this in a little bit later. Indices, information for commodity and energy markets, and analytics for investment professionals. And we're also going to come back to analytics for investment professionals. Over the last decade, S&P has returned 27% compound annual growth rate, significantly outperforming the S&P 500. Kind of funny how that works. The company behind S&P 500 ends up outperforming S&P 500 by a massive margin, by the way. The company generates 61% of its revenues in the US and 39% internationally. SPGI has 4 diverse business segments. They actually have 5 now, but this article is a little bit dated. It's from about 3 years ago at the time of this recording. SPGI has 4 diverse business segments operating in the $12.7 billion credit rating industry, $4.1 billion index provider, as well as providing data analytics benchmark prices for commodities and financial data platform. The chart below disaggregates SPGI's revenue by segment since 2011. All figures except years are in billions. In 2020, the company did, it goes on to, at the time of this article, they had a $112 billion market cap. They're at 135-ish currently. So stock price hasn't moved much since this article was written. This is a visual on SPGI's revenue by segment. And again, I'll leave the article in the description. But now that we have a basic understanding of SPGI, I want to actually go to the Paint app because I'd like to paint the relationship that exists between SPGI and any company, any big corporate that would like to go to the market to get debt. And there's really a couple of parties involved here. So first, of course, we have the company. We have the company that wants to take out debt, but this company, we don't know how how creditworthy this company is, right? Like, what if they already have a lot of debt? What if they're an unprofitable company? They're going to use this debt to fund their unprofitable business, and there's chances of default risk, right? So party number two, the lender, right? This could be your typical bank. This could be a JP Morgan or a UBS or TD, RBC, whatever bank really, right? These banks need to decide, hey, do we think that Microsoft is a creditworthy company? Are they going to return to us back our money, right? Or it could be like a tiny little startup, Cloudflare, 10 years ago. What are the odds that if we lend them money, they're going to be able to pay us back, right? Third party involved would be, of course, S&P, if I could do the and part, whatever, S&P. That's not how it's spelled, but anyways, that'll do. So, or we could say it's the CRA, the credit rating agency. So what the CRA, or S&P in this case, would do is they would go and be like, hey, so Microsoft wants to take out some debt. Let's do a analysis and try to figure out whether or not Microsoft is creditworthy and to what degree is Microsoft creditworthy. So this is where you'll see the AA, the AAA, the triple C minus, whatever the case is, right? They each have their own version of doing it, but realistically it equates similarly. So a triple C in Moody's might be a double C minus in S&P, so on and so forth, right? And based off this information, the lender or the bank will be able to issue a certain interest rate to the company that's trying to take out debt. And based off that, they'll be able to accurately assess the risk. And it's very accurate, by the way. I know 2008 happened, but a double A behaves like a double A, a triple C behaves like a triple C, and very accurate scoring models. And this business has existed for decades and decades and decades and has been improved upon over time. So anyways, now that you kind of understand the relationship between that, I'd like to give my own personal analogy that I've come up with. It is a work in progress, so bear with me here. But long story short, the analogy I've been able to come up with is an example of the principal at a local high school, right? So if you're at a local high school, you obviously need reference letters to get into universities and so on. And you might want to go to the principal, you might want to go to the teacher, you might want to go to all these different people that will be able to provide you a reference letter, right? And say that you're such a great student to apply to a university, right? So maybe we could write this out here. So you are a student, you're seeking to get into university, and you go to the principal and you ask him, hey, can I pay you $10 just for you to write up a reference letter for me and make me sound good, whatever, right? Or just be truthful, right? And over time, the principal picks up on the fact that, hey, these reference letters are really taking a lot of my time, and I hate writing these, and I got to make them all personalized and this and that. So he goes in the workshop, and through the sheer power of artificial intelligence, he's able to create this machine that'll write the reference letter exactly to his writing style, and it makes it on time, and it takes him a fixed amount of money. Let's just call it $1,000, right? It takes him a fixed amount of money to make this machine, and then over time it costs him, let's just say, $5 per hour in order to run this machine, right? And then he realizes, hey, so I've put up this one-time big capital investment of making this machine and having it be able to write like me, and then it costs me a fixed amount to continually run it, to pay for electricity and all that type of stuff, right? And pay for the paper and all that type of stuff. But my upside to continuously make money on this reference letter is nearly infinite, because it doesn't matter to me if because it's this AI robot that's just running on its own, right? And it'll just be $5 per hour. It's a fixed amount. It doesn't matter to me if I write one letter during that hour or if I write 100 letters during that hour, because the AI is able to just compute that all. And realistically, the cost for electricity is marginally higher, but I'm making a lot more money through the reference letters, right? So over time, he picks up on this and he starts offering his services not only to the high school he works at, but to the nearby high schools. And over time, he's able to gain traction and be known as the person that makes all these reference letters, right? And writes them all and does them very well, whatever the case is, very accurate reference letters. He improves on the AI bot over time. He invests a little bit more into the AI bot, and the AI bot becomes more accurate, better at writing, so on and so forth. And then over time, he realizes, hey, this AI bot of mine is, writing a lot of letters, and it's picking up a lot of information, and it's very personalized, and this is quite valuable information because I get to see the transcripts of all these different students. What if I went to the universities and I offered to the universities, hey, odds of you accepting this student is X, Y, and Z because this student took English class and science class at the same time, and based on my scoring models and my statistics and my data, I know that a student who took English and science at the same time in grade 11 is going to do exceptionally well in the engineering program because X, Y, and Z reason. And you harness that data and you sell that data to the universities. So what we have here is a double-sided moat where, because they have a lot of history of these reference letters and all these pieces of data, right, from doing the scoring or doing the reference letters, they're able to garner that data and repackage it and sell it on the other side to people who would care about that data. So universities in the case of the analogy, or in the case of SPGI, it could literally be anyone, right? Like when you pull up Yahoo even though Yahoo Finance I think uses FactSet, but places like Yahoo Finance, CNBC, or even Seeking Alpha, all these different websites, right? I believe FinChat as well, which I frequently use in my videos. FinChat uses S&P Global data. They all use S&P Global data of the financial markets and so forth, right? So anyways, now that we've gotten my very long-winded analogy out of the way, I'd like to dive a little bit deeper into this article before we jump over to the investor presentation. We go over that. Before we do that, though, as always, you guys know that my Twitter, I publicly track my portfolio at all times. Every time there's like a major change, if I buy something or whatever the case may be, if I sell something, I usually update this, and I kind of randomly do it like every week-ish. So this is usually very accurate and very truthful to what my portfolio actually looks like. As you can see, S&P Global is a very small holding in my portfolio at the time of this recording. I do plan on making it bigger, but as we dive a little bit deeper into this video, you'll see why I am not buying, even though there's been a fairly decent price decline over the past 1 month or 2 months or so. Anyways, moving on. So over here, he goes over the ratings business and why it's such a strong business, such a, like the term cash cow is often used when trying to describe this. But he goes on to say, ratings is Standard & Poor's largest segment by revenue. Ratings comprises of nearly 50% of revenue and contributes to 57% of operating profit with an outstanding 65% operating margin. So as I just mentioned, it is quite literally a cash cow. Again, at the time of this article being written, it was a bigger pool of revenue and also a bigger pool of operating profit. But since then, they've had an acquisition, which has thrown off these numbers. It's closer to a third and like 40% of profit, I believe, just off the top of my head. As demonstrated below, ratings cumulatively has over 1 million credit rating outstanding. So again, going back to the example, they have 1 million credit ratings that they've issued to all these different companies and all these different countries and all these different like entities that would need to take out debt. And over time, they monitor these and they re-rate them, and there's upgrades and downgrades and all this other stuff, right? And in effect has rated practically every relevant corporate, government, and structured finance debt instrument, bank loan, and corporation in the United States. I'm going to read that one more time. In effect has rated practically every relevant corporate, government, and structured finance debt instrument, bank loan, and corporation in the United States. So they rate literally everything. And as we dive a little bit deeper, I'll actually point out as them and their competitors could technically all have 100% market share at the same time, because the company could get multiple credit ratings at the same time, just as like a second opinion type business. But that's for later on. Here's a chart again, S&P rated volume, and then number of rated issues. I believe this is in millions. So this is 11 million. That doesn't make too much sense. But anyways, a lot of ratings, right? Ratings protected by regulatory barriers. This is something I actually forgot to mention. There's only ever been 4 major credit rating agencies throughout the history of 150 years of this business. And that was because it's essentially a government-enabled monopoly, or oligopoly, I should say, because during the Great Depression, they really needed the credit to be extremely accurate. And the only 4 businesses at the time, or the 4 companies at the time that were extremely accurate and met that bar was Moody's, S&P, it was Standard, it was Poor's, Moody's, and Fitch. And as it stands today, it's Standard and Poor's, which have merged together. There's Moody's and there's Fitch. Exactly the same way it was literally 100 years ago. Goes on to say, protected by regulatory barriers to entry, brand and historical accuracy. This brand thing's a pretty big deal as well. Moody's obviously has brand, but I think S&P Global, because of S&P 500, has a little bit more brand compared to something like Moody's, especially when it comes down to analytics and stuff like that. Has compounded revenues at 7.4% annually since 2011, while exemplifying tremendous operating leverage as operating margins have expanded 25% over the past decade to 65%. This is no joke. Businesses would love to have a operating margin of 25%, period, let alone have an increase of operating margins by 25%. Just truly amazing cash-rich business, drowning in cash. To provide context, the business did 3.6 billion in revenue and brought in 2.3 billion in operating profit. Ratings, initiation, and surveillance revenue has high incremental margins due to its primarily fixed cost nature. This is what I was mentioning in my analogy about the principal. So they have this fixed cost of figuring out the scoring model and how to do the scoring model and whatever. And then obviously they got to pay their employees and so forth, right? So pretty generally fixed cost and making the reports, so on and so forth. But each additional upgrade or each additional, surveying the rating and making sure it's accurate still, and upgrades, downgrades, and so on and so forth, is extremely high margin, because the upfront cost of coming up with a rating is done years and years ago, and then you just monitor that, and it's much cheaper to continuously monitor that. The primary expense is SG&A. Makes sense. Sales, general, and administrative costs. So this is you're paying your employees. This is paying for the building. Actually, no, that would be CapEx. That's not included in there. Sorry. I guess paying for rent in the building, stuff like that. The company must maintain the staff to survey the 1 million ratings outstanding. The segment has actually commanded less capital investment over time as annual CapEx. So this would be buying like trucks or cars and buildings and so on and so forth. Has fallen 31% since 2015 to 33 million, or only about 1% of revenues. To give you an idea, Apple, which is considered a very capital light business, is around 3%, right? Generally, I think anything over like 10, 15-ish% of revenues is considered pretty capital intensive. That's where you start to get into like the car companies and so on. Or like another example would be Intel. I think Intel's in the 30% area, so they're extremely capital intensive. So out of every dollar of revenue, not profit, guys, revenue that comes in, they spend a third of that reinvesting back into the business, into hard assets of building factories, building company trucks, or buying up buildings and offices and all this type of stuff, right? However, revenue has not been negatively impacted by the reduced investment, has continued its steady compound annual growth rate. So again, they don't need to reinvest into the business. They don't need to buy new offices. They don't need to build new anything, right? They're not like AWS that needs to keep making data centers and all this stuff, right? They don't need any of that. Instead, they've created the scoring model decades ago, and they're just, it's like a money tree they've created, and they're just eating the fruits off of this money tree. So moving on, I was going to go through the earning call or the investor presentation, but I guess we'll do it quickly because this video is kind of running long. Here, they give some guidance, whatever. Strong customer retention. Yeah, so they do have very strong retention rates, which is great. Here they outline what is high yield investment grade, other. This is junk bonds, guys. I guess they put it in the other category. Other includes, oh, okay, no, I was wrong. Never mind. Ignore what I just said. They do actually own Carfax now. So the acquisition they made as a part of that company they bought, IHS Markit, Carfax, which if you ever went to buy a car, it's one of the things to look to see if the car's been damaged or whatever the case may be. Moving on, talk a little bit about AI, proprietary data. I have no idea what this is meant to be. Yeah, net zero, okay, whatever. This is all the different segments, right? So as it stands currently, there's 3 main segments to the business. Here there is 5, but I kind of group them together. So I say mobility, commodity insight, and market intelligence is just all the different data components, right? So they have data on mobility, commodity insights, and market intelligence. This is more like your financial data, commodity data, and then this is car stuff. This is the part of the business I understand the least. I've dove pretty deep into this business, but I still to this day I haven't really figured out mobility part. There's Carfax, and that's about it. Obviously, you have the indices, which is your S&P 500 index and literally everything else, Dow Jones, whatever. And then the holy grail of the business, ratings. And you could see the operating margins here. So by far, the most productive parts of this business is the core ratings business as well as the indices. Right here is a revenue breakdown of all the different segments. So you can see that ratings as a percentage isn't that big of the revenue. Well, it is the second biggest revenue pie. It's just that it provides for significantly more of the operating profits compared to the pool of, again, it goes back to this up here, right? So indices and ratings are the highest operating profit parts of the business. So less percentage revenue wise, but bigger percentage profit wise. Just some other stuff. Compensation. Yeah, I'm going to link this in the description as well for you guys if you wanted to look at it further down. But Dow Jones, yeah, it's always good to take a brief look at the investor presentation. Moving on, this is FinChat, not sponsored at all, but they have a great product, so feel free to go use their stuff. You don't need to buy the paid version, by the way. The free version's quite nice. This, I guess I kind of have it up already. I was gonna pull this up as we go, but as you can see, this is the free cash flow, which, if you didn't know, free cash flow is, you shouldn't be valuing off of PE. Free cash flow is just the way to go. But yeah, as you can see, for this company, stock-based compensation, which is often a killer for free cash flow, it is not that high for this business as a percentage. I don't know what it would be. I don't want to embarrass myself here, but maybe about 5%, I think, 4 or 5% ish of free cash flow is ate up by stock-based compensation. And then on top of that, adding back to the capital lightness, if that's a word, of the business, you could see that it's only about $100 million in capital, only $100 million in capital expenditures. So again, buying your offices, whatever. But I do expect this to go down. I think just because of the recent acquisition, they've had to buy some offices or whatever the case may be. So might be a little bit higher than usual. But as you can see in 2021, when that article was written, it was only $35 million. And compared to the $3.5 billion in free cash flow that they made, peas, right? If we stretch this out, another thing I guess I should have mentioned all the way at the start of the video, S&P Global is a very, very consistent business. They rarely, like, for example, I should have pulled this up in the investor presentation. Oh, beautiful, right here. Okay, I guess we'll go find it. But they said they expect to do $4.3 billion in free cash flow for next year. So yeah, this is the revenue guide. Wow, I didn't know that. 5% expansion in operating profits. That's incredible. 10%. Oh, is this for different segments? I'm very confused here. Initial gap. Oh, I guess this is, yeah, it's adjusted numbers. I don't know what they've adjusted into that. So yeah, I guess they give you that. Are you serious? Okay, anyways, I thought it would be in here, but they've got it for $4.3 billion in free cash flow next year. I 100% think they could definitely reach that. This is a business that is extremely consistent, and they've shown in the past that they're extremely consistent. So if we assume that they're going to make roughly 4.3 billion in free cash flow next year on a forward basis, actually they have it right here for us, perfect. On a forward basis, that lands you at about 3 and a little bit percent free cash flow yield, or 31 times price to free cash flow. In a little bit, we'll dive into why I think that's a little bit expensive, especially for this type of business. I don't think they're going to be growing free cash flows at the mid-teens range like they have historically, but just me being conservative. Anyways, I just wanted to show this compared to all this other stuff, very capital light and not a lot of stock-based compensation. And we could even pull it up now, might as well, like something like Tesla, right? Capital intensive car company. And we just scroll down here into free cash flow, get free cash flow. We also need capital expenditures. So as you can see, right? So let's mute this, right? Looks great. Okay, they were very free cash flow negative, so they were bleeding a lot of money back in 2017. Then the script flipped and started going the other way, peaked at 7.5 billion. Okay, great. Very profitable business, right? Peak buying Teslas and Fed printing money, whatever. But then you look at the CapEx on the other side of it, right? So if in theory Tesla were to not reinvest, not build factories tomorrow, their free cash flow would immediately double, right? If we just take 2022's numbers at face value. If they were to, in theory, this isn't going to happen, it's a car company, CapEx is never going to be zero. But in theory, if they were to do that, and they were more similar to a business model like S&P Global, right, where, keep in mind, they have almost no capital expenditure compared to the free cash flow, their free cash flow, or you could just think of it as their profits would double overnight. It's even worse in 2023. That's nearly 2 and a little bit more times CapEx compared to the free cash flow. So it would triple. Their free cash flow would triple overnight in theory if they were to cut out CapEx. So this is why we don't like to invest in capital intensive businesses and prefer something like this, because they can return it to the shareholder through the buybacks and the dividends and so on and so forth. Moving on, I want to wrap this up quickly just because I've been ranting for 27 minutes. This is a calculator that I've came up with myself. As you can see, SPGI doesn't rank too great, kind of middle in the pack between all the different companies I'm looking at. But my methodology with this is to take the free cash flow yield that the company is currently trading at and divide that, or I guess I take price to free cash flow and divide that by how fast it's growing, right? So if a company has a price to free cash flow of 10, meaning the valuation of the company, right? So the market cap of the company over here is 10 times the amount it's making in free cash flow, then they're growing that free cash flow at 10% per year. That would be a ratio of 1, right? So if they're trading at 10 times their cash flow, growing it at 10%, that's a ratio of 1. If they're trading at 20 times their cash flow and growing it at 10%, that's a ratio of 2. So in the case of S&P, it's 2.43. So meaning in stock-based comp adjusted, or I guess let's just take normal free cash flow, right? 4.3%, but 5% of it goes to stock-based comp. You end up with 4 billion in stock-based comp adjusted free cash flow. And the market cap of the company at the time of this recording is 133, and that free cash flow is expected to grow at about 13.5%, right? So it gives you a price of free cash flow of 33 divided by 13 gets you 2.43. And yeah, not exactly an attractive buy at the moment, but I wouldn't blame anyone. Maybe about 10% lower, I would be interested to go heavier. But yeah, I believe I covered everything. Thank you for watching. Have a great night.